In 1944, 44 nations trusted the US dollar to rebuild the world. What they didn't see was the beginning of a new empire, one ruled not by armies, but by interest and debt. How the US turned debt into a weapon isn't just history. It's the story of how America gained silent power over nations, and how that power could now become its greatest threat. What really happened when debt replaced gold? In July 1944, delegates from 44 nations gathered at the Mount Washington Hotel in Bretton Woods, New Hampshire. Their task was urgent: rebuild a shattered world economy and prevent another descent into depression and war. The solution they crafted was both simple and radical. Every currency would be tied to the US dollar, and the dollar itself would be fixed to gold at $35 an ounce. This arrangement, hammered out in closed-door debates, gave the United States a unique advantage. By 1950, America controlled nearly 3/4 of the world's gold reserves, making the dollar the unquestioned anchor of global trade and finance. Behind the scenes, U.S. Treasury official Harry Dexter White pushed for a system that put the dollar at the center, while Britain's John Maynard Keynes argued for a more balanced approach. White's vision prevailed. The institutions born at Bretton Woods, the IMF and World Bank, were built to run on dollars, not on a new global currency. The world's recovery would now depend on American credit, with every loan and reserve reinforcing the dollar's reach. In August 1971, President Richard Nixon announced that the United States would no longer exchange dollars for gold. Overnight, the foundation of global finance shifted from metal to paper. With no gold constraint, the U.S. could print dollars at will and borrow without limit. Federal debt, just $370 billion in 1970, soared to $2.8 trillion by the end of the 1980s. The rules of the game changed again under President Reagan. Deregulation swept through banking, breaking down barriers between lenders and fueling a new era of easy credit. The Depository Institutions, Deregulation and Monetary Control Act of 1980, followed by the Garn-St. Germain Act in 1982, allowed banks to compete for deposits and make riskier loans. The Tax Reform Act of 1986 encouraged a wave of debt-financed corporate takeovers. Through it all, the Federal Reserve emerged as the new command center, using interest rates and liquidity to steer not just the American economy, but the fate of currencies and governments around the world. When the Federal Reserve raises interest rates, the effects ripple outward in a precise sequence. Higher U.S. rates instantly make American assets more attractive, pulling global capital toward Wall Street and away from riskier markets. Dollars flow back to the U.S., draining liquidity from emerging economies and weakening their currencies almost overnight. As local currencies lose value against the dollar, the cost of repaying dollar-denominated debt climbs sharply. Governments and companies that borrowed in dollars now face a squeeze. Their revenues, earned in local money, buy fewer dollars needed for interest payments. This mismatch grows with every uptick in U.S. rates. Investors, sensing trouble, withdraw even more funds, deepening the currency slide and raising borrowing costs further. Countries with large external debts must either raise their own rates, hurting growth, or burn through reserves to defend their currency. If these defenses fail, access to new financing dries up. The cycle ends with governments forced to cut spending, seek emergency loans, or default altogether. Each step in this chain reveals how a decision in Washington can trigger crisis far beyond America's borders. U.S. federal debt has now climbed past $35 trillion, outpacing the size of the entire American economy. The world's central banks still keep nearly 60% of their foreign reserves in dollars, anchoring global finance to American policy decisions. But for many countries, this tie is a source of growing danger, not security. Argentina, Egypt, and Sri Lanka each owe more than 70% of their external debt in dollars, locking them into a cycle where every move by the Federal Reserve can tip the balance between stability and crisis. When the dollar strengthens, their local currencies weaken, and the cost of repaying debts balloons almost overnight. The numbers reveal how deep the exposure runs. Argentina holds over $140 billion in dollar-denominated debt, Egypt more than $80 billion, and Sri Lanka over $23 billion. These obligations are not abstract. They dictate budgets, shape elections, and decide whether governments can pay for fuel, medicine, or salaries. The scale of this debt mountain leaves entire economies at the mercy of decisions made in Washington, exposing the fault lines that run beneath the global financial order. In Ghana, the numbers tell a story of impossible choices. The government now spends more on interest payments than on healthcare and education combined. Clinics face medicine shortages and teachers wait months for salaries. A health official in Accra describes days when basic supplies run out before noon, while children are sent home from school because the lights go out. These are the costs of debt service in a country where every borrowed dollar must be repaid in dollars, no matter how weak the local currency becomes. Zambia's struggle is even starker. Government debt soared to 133% of GDP in 2023. As the government scrambled to meet its obligations, rolling blackouts swept across cities and villages. Power cuts stalled factories and left classrooms in the dark. A young engineer in Lusaka recounts halting construction on a long-promised bridge, funds earmarked for infrastructure now redirected to foreign creditors. Across Africa and South Asia, 60% of low-income countries stand at high risk of debt distress, forced to cut imports, delay salaries, and sacrifice public services just to keep up with rising interest. The price is paid not in abstract numbers, but in daily hardship. Household debt in the United States now stands at $17.5 trillion. This includes $1.7 trillion in student loans, money borrowed for degrees that often fail to guarantee financial security. For many Americans, debt is not just a tool for investment or growth. It is a daily burden that shapes choices about work, family, and the future. The divide is stark. The wealthiest 10% of Americans hold nearly 70% of all wealth, while the bottom half share just 2.5%. In cities like Cleveland, Detroit, and Las Vegas, families face sharper shocks when interest rates rise. Mortgage payments jump, credit card bills pile up, and layoffs ripple through industries that depend on cheap financing. In these regions, the promise of upward mobility fades as borrowing costs climb. The system that once fueled suburban dreams now threatens to trap a generation in cycles of repayment and insecurity. Debt, once America's engine of prosperity, has become a source of fragility, turning the country's own financial weapon inward. While the dollar remains the world's anchor, new rivals are gathering strength. The BRICS nations, Brazil, Russia, India, China, and South Africa, now account for a third of global GDP by purchasing power. Over the past 5 years, China and Russia alone have added more than 1,000 tons of gold to their reserves, building a financial shield against dollar shocks. Alternative payment systems, like China's cross-border interbank payment system and Russia's MIR network, are quietly redirecting trade outside the reach of Washington. These moves signal a growing desire to break free from the dollar's grip. Warnings from inside the system are growing louder. Economist Nouriel Roubini describes the world as drifting toward a slow-motion debt crisis, where rising interest payments threaten to outpace even military spending by the end of this decade. The Congressional Budget Office projects U.S. interest costs will reach $1.4 trillion a year by 2033, straining federal finances and testing investor faith. 3 paths lie ahead. If inflation cools and growth holds, debt may stabilize, high, but manageable. If trust in U.S. Treasuries falters, the dollar could lose its reserve crown, triggering capital flight. The most likely outcome? A long, uneven decline, with new regional currencies rising alongside a weakened dollar. Policymakers debate digital dollars and stricter spending rules, but the world waits for the next move. The balance of power is no longer set in stone. As of 2025, the U.S. national debt has surpassed $35 trillion, more than 120% of GDP. This documentary traced how a system born at Bretton Woods in 1944 gave America global financial leverage, only to see that power grow and become more fragile after the gold standard ended in 1971. The evidence shows, when the Federal Reserve raises rates, countries from Ghana to Sri Lanka cut vital services just to pay interest. while American households now owe over $17 trillion. Yet many IMF and Treasury documents remain classified, leaving some decisions behind closed doors. Today, the dollar still anchors 60% of global reserves, but alternatives are rising across BRICS nations. Expert forecasts agree. Unless policy changes, U.S. interest costs could exceed $1.4 trillion a year by 2033. The facts are clear. Debt gave the U.S. power without force, but the same system now tests its own stability. Empires are no longer lost on battlefields, but on balance sheets.